Welcome in, welcome in. I'll give it a few seconds to let people kind of draw in and get settled in. But good afternoon, everyone, and welcome to the one, two, threes of R&D tax expense deductibility. My name is Jung Hun Chung, policy lead here at SSBA, other known as the Small Software Business Alliance. And we're all very glad to have you all join us today. Over the past several years, many of you, founders, developers, and small tech leaders, have been navigating real uncertainty around Section 174. What was once a straightforward pro-innovation tax treatment suddenly became a major financial and operational burden for startups. For a lot of small teams, this wasn't just a tax issue, it was about cash flow, hiring decisions, and whether you could continue building the products and services that mean so much. That's why the recent policy changes are such a meaningful win. This didn't happen by accident, it happened because this community showed up. Our members shared their stories, engaged with policymakers, and made it clear that innovation policy needs to work for builders of the digital economy, not against them. So, on behalf of SSBA, I want to sincerely thank you all for your advocacy and continued engagement on this matter. This was a big win and a big moment for small tech developers, and you all made it happen. Now, with that win in place, we're entering a new phase and quite frankly, a confusing one. Policy has moved faster than implementation, IRS guidance is still evolving, and many businesses are left asking, what does this actually mean for me? How do I take advantage of these changes? And what should I be doing right now? That's exactly what today is all about. We're going to break this down in a practical, founder-friendly way, what's changed, what hasn't, and how you can approach R&D expensing moving forward. To help us guide us through this, I'm joined by two experts who are working directly with businesses navigating these changes every day. First, Erika Farr, tax director at BPM, a top accounting and advisory firm. Erika's work and leadership focuses on R&D tax planning and account method changes for technology and software companies. Joining Erika is Matt Roberts, CPA and founder of Better Credits, a fellow SSBA member as well as a thought leader in the R&D tax credit scene. Better Credits specializes in R&D tax credits for small to mid-sized businesses, and Matt's work is all about making complex federal tax incentives practical and accessible for companies like yours. Matt and Erica, thank you for being here today, and I'll throw it over to you all to start our conversations today.
Thank you, John. This is Matt. I am, as John said, I'm the founder of Better Credits. I am, for the last 22 years, kind of like a one-trick pony. My focus has been on research, helping companies calculate, scope out, calculate, document, defend research credits and Section 174 analysis. I'm not an accounting methods expert. That's why Erica's here. And so I want to make one distinction too, or I want to call it two things. One is BPM, Erica's team, they have a broad scope of services that they can offer. Like they have obviously you can reach out to either one of us. We're both here to support Jong and Alex and Graham, the whole team, because we really appreciate kind of what they've done. And even Michelle Hansen before that. Some of y'all are probably here because of Michelle, right? And so we're grateful for their efforts, right? Because they really did help get legislation done and the fix done. But so that's why we're here. But two is if you reach out to us, just I want to keep that in mind, right? Like if BPM has their own R&D tax credit practice, right? A robust practice as well. So when looking at who to reach out, obviously we can reach out to either one of us, but in some cases it might make sense to just reach out to Erica at BPM just because they have kind of that broad scope as well. So that's one thing I'll say. Also, I'm not sure if I'm allowed to do this, but shameless plug for Michelle. I don't know if she's on, but Michelle Hansen, Deploy Empathy. I just bought this book from her. I'm on page 8, which is not very far, but I love what they do. And if you're on, appreciate you. Okay. So the whole point for today's goal, the focus of today, this is not a technical deep dive. We're not trying to make you into a tax expert. I don't think that's necessary. I think that the point here is really to surface the key decisions that have to be made, that you should be communicating with your CPA. One is that whether or not you're an eligible, you'll be able to do this is understand whether you're an eligible small business that can take retroactive relief. Two is whether or not what are the two kind of key decisions you have to make for this year, right now, and regarding the cost that you incur today versus the legacy cost that you've incurred in the past, but prior to 2025. And then what elections and statements that they have to make, include on the returns, and then arm you with kind of a short list of questions that you should be socializing with your CPA. And this is not, it's not a gotcha or anything. It's really just arming you with these are the things that what we know should be considered. Have they considered these, right? And I think that will really surface whether or not there's some gaps there, and ultimately decide if you maybe need to extend, right? Because so that's the goal for today's call. I will say today is March 26th. So there are some of you on this call that maybe are pass-throughs, a partnership, S Corp that may have already filed, 10, 11 days ago, right? A lot of you are corporations filing 1120s that are due 415, calendar year taxpayers due 415, that you may be deciding right now whether or not yours, this is very good timing is what I'm trying to say is there's not a lot of you that your C Corp haven't extended yet. And it's a great timing to kind of surface these questions and determine, hey, maybe they have it all covered and maybe they do, right? Or maybe they need to be filing an extension for you to give you a little bit more time to digest and make sure that you're optimizing your position. So go on to the next slide, two slides, another one. So hopefully that makes sense. So what is 174? So I'm just going to give a real quick refresher. I know we're all probably painfully aware of the 174, but the TLDR really is one is research or experimental costs is a thing, right? It's a construct. It's been around in the tax code since the 50s. It also importantly includes developed software, right? Which is very appropriate for the audience today. Two is historically companies had a ton of flexibility in terms of how they could treat those costs from a tax perspective. You could amortize them. You could fully expense them under 174 little a, and take the full benefit, or you could capitalize them under 174, Section 174, our Internal Revenue Code 174 little b, or you could do a 59E election. You had a lot of flexibility, right? And that was all pre-TCJA. So the Tax Cuts and Jobs Act signed into law in 2017. The 174 provisions went to effect in 2022. um, Changed that, right? As you know, they basically said you no longer have flexibility, you have to capitalize. And not only that, but they also, it was more detrimental to foreign-based R&D. So domestic R&D was, you know, capitalized, amortized over 5 years, and foreign was and is over 15 years. So July 4th, 2025, One Big Beautiful Bill Act signed into law, these affix, right? And now in 2025, um, companies have that flexibility back, right? And there's some nuances in administrative stuff that have to happen, and there's also opportunity to make sure you're optimizing your position, which includes looking back, and Erika will talk about that. Um, I think what's important is that the flexibility is back, which is great. But it also keep in mind too that that's sans, foreign R&D, right? They've kept that, right? Historically, it didn't matter, right? Before 2021 or 2022, it didn't matter if your R&E was foreign or domestic from a tax perspective. You can just fully deduct it or do whatever you want, right? Essentially with it. That detrimental thing that came into effect because TCJA, they kept it in. So they didn't remove that. So there is still a disincentive, right, for companies to leverage foreign resources, and that is what it is, right? There's a lot of business, like really good business decisions, why there's amazing talent all over the world, right? And so there's obviously a lot of firms may continue, right, to leverage the model they have or lean into it despite this. So with that, um, I'll hand it over to Erica. We'll talk about what software companies need to know.
Thanks, Matt. So during this session, we're going to introduce the key changes for Section 174 under the One Big Beautiful Bill Act and IRS guidance provided in Revenue Procedure 2025-28. For software companies, these updates will impact how R&D costs are treated for tax purposes in 2025. The focus will be taking you through some practical steps to understand your choices, what to file with your return, and the implications for cash taxes and compliance. The new law and guidance generally restore flexibility for domestic R&D, but the outcomes will depend on deliberate elections and documentation. And our overview will kind of set the stage for actionable planning, ensuring your company is prepared for the new requirements and can optimize your tax position. Before we jump into kind of more detail, I want to acknowledge the eligibility rules for certain relief pathways. Many of the simplified pathways are designed to provide relief for small businesses and rely on a gross receipts test and not being classified as a tax shelter. The gross receipts test is met if a taxpayer has average annual gross receipts for the prior 3 tax years of less than $31 million. So for tax years starting in 2025, that would be your 2022 through 2024 gross receipts. You can work with your CPA to confirm eligibility. And the important point for today is the benefits and procedures can differ depending on whether or not you qualify. So you do want to start thinking about this analysis as early as you can before you commit to a filing approach. So for the rest of today, we're going to kind of think about the framework of Lane A and Lane B. Lane A will be for new costs starting in 2025 and beyond. And Lane B is for what you've already capitalized for tax years 2022 through 2024. For each of the lanes, we'll walk you through what decisions are available and then what to attach to your tax return and how it will show up on your tax return. When you're working with your CPA or preparing your tax return, you can kind of think through this mantra, what you decide, what gets attached, and how it shows up on the tax return. You can decide whether to expense, capitalize, and amortize. And once you make that decision, you'll either attach an election statement or a statement in lieu of a 3115, and then that will show up through a cutoff 41A, current year expense, or potentially on amended returns if you qualify for small business relief. And then we will now go into your options for 2025, your new R&D costs, Lane A. And so the core decision for 2025 is around your new domestic 2025 R&D costs. So the first option you have is to currently deduct domestic R&D costs under the deduction method. Or under option 2, you can capitalize and amortize domestic R&D over at least 60 months. A lot of people assume since expensing is back, they can just expense the 174 expenses on their tax return. But the reality is you have to adopt the method correctly on your return, and the attachment is what makes it real. Taxpayers that don't follow proper procedures could potentially be put on a method by that the IRS chooses in the future if they're selected for audit. If you choose the deduction approach, you can think of it as from 2025 onward, new domestic R&D gets deducted as incurred. Operationally, the IRS guidance allows you to make this change by attaching a statement in lieu of filing a Form 3115. The automatic change number for this is automatic change 273. And the key point here is it's just not an internal decision. Your return needs to have the proper attachment. Sometimes amortization could be a strategic choice for your company. For example, immediate expensing could create losses that you can't use efficiently or interact with other limitations or planning objectives. The key is that amortization is still available for domestic R&D costs starting in 2025, but you do have to make an election or um, method change and implement it properly. And you might be thinking, hey, I was already capitalizing and amortizing. Why do I have to, make an election? The thing to point out here is that the life and the methodology for amortizing the 174 cost changes in 174 Cap A. It goes from a 5-year, a half-year convention to a period of not less than 60 months. And once you make your decision, you're stuck with it for 5 years. So it's important to think that through, unless the IRS comes out with further guidance that waive the 5-year scope limitation when you change your method. Now we'll take a look at legacy R&D balances under Lane B. And for your domestic 174 costs that were capitalized in tax years 2022 through 2024, companies have to decide how to handle the remaining balances. Your options include continuing amortization as previously scheduled. You can accelerate your deductions into 2025, or you can spread your deductions between 2025 and 2026 tax years. If you are an eligible small business taxpayer, you also have the option to amend prior year returns. The right choice for your company will depend on the cash tax impact, profitability forecasts, and the administrative complexity. Proper documentation and elections are essential to support your chosen method and ensure compliance with IRS guidance. All right, and now we've gone through kind of the different options that you have, and we can talk through what should be attached to your 2025 return. Now, these are all things that you don't need to draft yourself, and you can work with your CPA, but this will give you kind of the general knowledge to know what it is and why it matters and what should be in there. So for your statement in lieu, at a high level, the statement will identify the taxpayer. It will provide the designated change number, which is DCN 273. This tells the IRS what change number you're filing, so they know, oh, this is domestic 174. And it will clearly state the method that you're adopting, either the 174 Cap A deduction method or the amortization method. If you're amortizing, you must also declare your capitalization and amortization approach. So for example, you are going to capitalize and amortize over a period of not less than 60 months. Additionally, you can also include your decision of what you're going to do with your legacy costs on this change number as well. And you do that by declaring what you're declaring what you're going to do, either deduct your unamortized costs from prior tax years in 2025 or split it between the 2025 and 2026 tax years. And this statement will anchor your tax position if the IRS ever asks, and it will also provide you audit protection if for any instance there were errors or something made in prior years, you have audit protection for that item, and the IRS can't go back and assess penalties and interest on 174. For small business taxpayers, there is a small business taxpayer election. This election is how a small business taxpayer tells the IRS which Section 174 path it's taking. Again, your CPA should handle the drafting of this. But when you're reviewing your return, you can look back here and remember that the statement should clearly identify your company, confirm your eligibility, document whether you're going to deduct or capitalize and amortize domestic R&D costs. It should also include a header that's filed pursuant to Section 3.03 of Revenue Procedure 2025-28. Again, these things just alert the IRS very clearly what you're doing procedurally on your return. I think one um, one thing that's really important to note here is the applicable due date for amended returns, which you have to affirmatively state you will file all amended returns by the applicable due date, is the earlier of July 2026, which is coming up in a few months, or 3 years from when you filed your 2022 return. For those of you who are not extenders, this could fall or may have already passed in early spring 2026. Um, Additionally, in this statement, you want to declare that you are not a tax shelter and that you meet the gross receipts test. And then this will be the record that supports your use of small business relief under the new rules. And finally, there is an option to make an election to capitalize and amortize. The election statement should be attached to an original or amended return or AAR as applicable. It's the formal notice to the IRS that you're opting to capitalize and amortize domestic R&D costs instead of expensing them. You'll note that the election to capitalize and amortize can either be made through this election statement or on your statement in lieu of 3115 or on your small business taxpayer election. So there's a lot of ways to do this particular one. You don't need to draft this yourself again, but what to look for when you're reviewing your return with your CPA is that includes the proper language provided in the revenue procedure, taxpayer information. It states which taxable year the election is being made, and that you will declare the expenses are charged to a capital account and amortized over a period of not less than 60 months. And again, if questions ever come up, this will be the document that explains why your R&D costs are being recovered over time. Finally, we'll walk through where does this go on your tax return. So I'm getting a lot of questions from clients about, hey, where should we be putting this? Does this show up as a Section 481A adjustment, which is something that you have when you make a method change? But the IRS in the procedures says that this change is made on a cutoff basis. So practically, the legacy amounts are going to show up as an amortization expense, and they will flow through your Form 4562, which is where you report depreciation and amortization. It's good to know, even if you're not preparing the return, you can just know where it is and use it for forecasting and tying out your tax return to any internal schedules. I also want to note that if you're taking an R&D tax credit, we are advising our clients to separately state current year domestic 174 costs as other deductions on their tax return. This is because there was a language change in Section 41D, paragraph D, and it now states that QREs are Section 174 costs. So this just makes it really clear to the IRS that the 174 costs are greater than your QREs. Now, Matt is going to walk you through some things to think about if you take an R&D credit, because there are some implications with some of the options I discussed above.
Thank you, Erica. Um, yeah, there are some important considerations, and there's no way to get around everything, all the important stuff that Erica just covered, right? I mean, a method changes and change numbers and all that, but it's like super vital. And you also brought up a couple really important points, right? Um, Especially around like the suggestion that the tax preparers separately kind of from not from an optics perspective, this sounds bad, but from a presentation perspective, that they consider presenting the 174A domestic R&D cost that you're deducting as another line item separately stated in other deductions. Rather, even though like why bother, right? You're just deducting, maybe you're just electing to fully expense it anyways. But to your point, we don't know like what kind of like um, inputs this tax return inputs that the IRS will use to kind of identify high risk taxpayers, right? And so it's another reason why, hey, just show it there, right? If they have some kind of like mechanism that checks if there's a credit and then checks in if there's a 174A disclosed amount, and if there's nothing there, that could, I don't know, I don't want to scare anybody, right? But that could, trigger or factor into their process. So the simple things that you can do to kind of minimize that, mitigate that risk. Um, Another important point I think was about, if you're an eligible small business or eligible business that want, if your average annual gross receipts, I think are less than 31 million, I think it is over the 3-year period, um, and you're eligible to take this retroactive relief. Um, there's a timing, there's a time frame, right? And to your point, 2022, I know that there were quite a few kind of extensions or extended due dates, because of natural disasters and whatnot going on. So I would first just go look at your return that you filed. When did you file it? If you extended or filed, it's based off of when you actually filed it. And if you filed it after, the due date, right, then that, and it's after, March 26th, right? Then you have more time to perfect that one and file the amendment. And then for the others, obviously for all of them, right, no later than July 4th, I believe. I think it's July 4th of 2026, which is coming up fast approaching. But aside from that, one important consideration is really about, well, there's a couple high level kind of suggestions here, right? One is um, when you're looking at the R&D credit, you should always be looking at the R&D credit and the 174 kind of implications together. I think a simplistic way, and I see this a lot, right, where they'll come to me, think, great, the 174 fix is done, let's claim this credit. Okay, great, but what have we done historically, right? So there's a broader discussion that has to take place. Um, and also, frankly, if you're one of those eligible small businesses that are able to do the retroactive application, we also need to consider the fact that there's this concept of the 280 cap C. Um, uh, I think the high level framing of this is essentially that this can factor in and become material in terms of determining whether or not it makes sense to amend. Um, the uh the context here is that the IRS has always perceived that if a company is doing development work, right, since the 50s, if they're doing any kind of development work, they're getting two benefits from that same cost, that the same cost incurred. One is well, since the 80s, they're able to get a credit, right, an R&D tax credit based off of a subset of those 174 costs. But they also get a deduction on the return, right? That reduces your income. So the IRS has always seen this as a double benefit. And so that's why they created 280 cap C that basically says, hey, if you're claiming the credit and taking the deductions, if you're taking the gross credit, you have to do an add back, essentially to reduce your 174 cost that you're expensing on your return, to deny that double benefit, right? It's just a simple mechanism, or you can choose to just take a reduced credit rate and um, avoid the administrative burden of like adjusting, making other adjustments. The second point is that, so that's what that is, right? The second point is that for 2022 to 24, there was this kind of beneficial treatment because 280C language changed. And the 280C language changed and essentially resulted in in that denial double benefit going away for many taxpayers. And so there was this period of time where you may have claimed the gross credit and not done any add back, and you could have had a larger net benefit, right? And so I bring all of this up, right, to say that for those small business taxpayers, right, that want to consider going back and filing the amended returns, that the IRS has said, hey, if you do that, you have to use the denial of double benefit framing. And so if you did claim a credit, an RD tax credit in 2022, for example, and you claimed the gross credit and you did the add back, or you didn't do the add back because you had a good tax advisor that knew that that law changed, and now you want to go back and avail yourself of the full expensing, you'll have to apply the add back, right? So it could change like the math, right? So that's one important thing I want to, it took a long time to explain that one thing, which can be material. The second thing is, I think it's the obvious thing, and I'm pretty sure there's nobody on this call today for which this applies, but there could be, taxpayers that maybe made the argument that they didn't do R&D, right? And they, as a result, 2022, 24, they're saying, hey, we didn't really do R&D because in order to consider capitalizing R&D would be, detrimental, have a significant tax impact or something like that. I'm sure it doesn't apply here, but and maybe because of that, maybe they also decided, we will pass on the R&D credit because, that would only hurt that argument, right? It's kind of impossible, right, to claim a credit for R&D and then claim that you don't have 174 cost to capitalize. And now fast forward to 2025, because of all the amazing work that you all did and Michelle did and all those others, including the folks on this call today, John and the team, that we got the fix in, right? And it's a little messy, but it's good, right? We got a fix in. So now companies are saying, hey, it's all done, it's all fixed. So now let's engage, let's claim these credits for 25. And I would just pause. One is, I think, yes, that you should be doing that for sure. But secondly is that just remember that this credit is a credit for increasing research activities, right? So there's a continuity requirement. You have to calculate and make assertions about your historical qualifying spend, and it has to be kind of consistent. It has to be consistent with what you're doing today, and you just really want to make sure that your facts line up right, and maybe there's an opportunity to just if there's anyone on this call, right, that maybe didn't comply with the TCJA capitalization. I think there's an important kind of inflection point that should be considered, which is like, do we use this opportunity to kind of just get right? That could be, I'm not an accounting methods person. That's why Erika's here. But like, there could be scenarios where it's non-automatic and and it can be messy and maybe costly, right? And without doing that, maybe you open yourself to exposure, right? If you don't, and what I'm talking about is essentially saying, yes, they had this capitalization requirement, but now it's gone, and maybe let's just proceed as if nothing happened, right? And I think that there's definitely risk and exposure associated with that. But I think that you should be, one is considering whether or not there's an opportunity here to just to get right, and there's some favorable adjustments, right, that may allow for kind of mitigating or lessening the impact of the detrimental impact over time that Erika can kind of walk you through as well from the accounting methods perspective. But I think it's a good time to kind of reconsider what your options are and or just understand what exposure you're taking on. And then it's about, hey, what are we doing for 25 R&D tax credit? Let's calculate it and establish what the base is. I think that those are the main points. I'll hand it over to Erika. Sorry.
Right. Summing up what we've talked about, and preparing for your 2025 tax filing, companies can kind of follow the workflow that we've walked through. First, confirming your eligibility for small business taxpayer relief, then deciding your treatment for your legacy, your new and your legacy domestic R&D costs, making all of the necessary elections, and attaching the required statements to return. Consistent documentation of cost categories and methodologies is critical for compliance and audit readiness. And then keep in mind that foreign R&D expenses remain subject to 15-year amortization. And completing these steps should ensure that your company's tax position is both defensible and optimized for current and future filings. And then Matt will highlight some questions that you can ask your CPA.
Yeah. And so this is kind of the summary here, right? And it hits on everything. And again, this is really intended for you to have that kind of frame up and have kind of expose like what have they thought about and what have they not, and expose if there's maybe gaps or areas that need to be considered through them, you or them, leveraging the technical, accounting methods folks and R&D 174 kind of subject matter experts. We're also available to help support them and you, however, right? But these are the framing, right? It's what are we doing, right? It's the method that we're using for new domestic R&D, right, for 2025. What are we doing with the old stuff? Because there's some planning there around whether or not you continue to amortize, right, or you make an election to take all of that deduction in 25, or you spread it 50-50 over 25 and 26. That requires modeling, right, to make sure you're optimizing. So it's really good to kind of frame these things, right, if they haven't been discussed before. The third is like, are we aware of what attachments and statements and perhaps statement in lieu of or method changes that have to be filed, right? Four is the whole kind of consideration I talked about around the RD tax credits and the consistent messaging about what your historical fact pattern has been versus the eligible small business or the eligible business that want to avail themselves of the retroactive treatment, filing amended returns, and whether or not in the 280 Cap C kind of posture there. But then it's also documentation retention, and then very importantly, which we haven't really talked about this, which is like a whole another probably a whole another webcast, is what's the state implications for 174A. I'll tell you, there's 50 states, right? And they all have varying conformity to federal law, right? And so depending on the point here is that the 174 capitalization isn't dead, right? And it's alive and well depending on which states that you have nexus in and are filing. For example, California, I don't know the date, but I think they conformed with the federal rules from like as of like 2009 or 2011, some point before TCJA. And they also, by definition, they also don't conform to OB3, right? The One Big Beautiful Bill Act 2025. So for them, they're not even aware that there was this capitalization and this fix, right? So for California, it's a non-issue, right? There's no capitalization requirement. I'm not oversimplifying things, but like other states, it like runs the gamut, right? And there's a state like Maryland who has a robust R&D tax credit regime. Two is for example, I believe that they do conform to the TCJA 174 rules, so the capitalization requirement, but they also don't conform with the OB3 174. So the fixed wasn't fixed for Maryland, right? So for Maryland, for example, right, there's still this capitalization requirement. So there's still this need um, from R&D study perspective, 174 analysis perspective, tax compliance perspective, to continue to track those costs because they're going to be treated differently for certain states. So that all depends on what state that you're in, that you have nexus in, where you have R&D activities, and so that's a really important point that is kind of beyond the scope of this session. And it is, I'll tell you, it is it's kind of a full-time job and of like keeping up with all this, right? And I think a lot of these compliance, there's a lot of these states are fast moving and introducing legislation to conform and change the way that their conformity is. So it's a moving target. Um, um, but I think the takeaway there is that, and frankly, too, like everyone's busy and the compliance teams are really busy too, and they may not be really fully vetting out all these things kind of in a timely manner that serves your best interest, right? So these are the questions really, right? If you frame these up with them and you do it now, and I think it will really kind of expose kind of one, maybe they're in a really good position. They've already thought of all these things and they're great, and they've got subject matter experts supporting them on their team, right? Or that there's identify that there's maybe a need to vet some of this stuff out. This last slide is really just a summary, right? It's really a summary key takeaways, right? Deliberate choices that need to happen in 2025. What do we do with the legacy? Do we amend? Do we not? How do we treat those costs going forward? There's flexibility there. What accounting method changes, and then obviously to coordinate the 174 and the credits discussions, before you file and kind of holistically, so that you don't inadvertently get tripped up. I think I should have talked slower because we had 3 minutes. I was trying to target 15 till, but I think we'll leave it
No,
at that. Then open it
it's
up to
completely fine.
Q&A.
And again, I'd like to thank Matt and Erica for all their expertise. I've had the pleasure to talk to Matt and work with Matt and as well as Erica over the past few weeks, and truly don't know really anyone in the ecosystem who knows more about these issues than these two people. Which I'll have their contact information in the next slide. But we want to do a few Q&A questions. Got a few already set up and a few from the audience, so I'll try to keep it brief to a degree. But I think the first question, and this kind of moves, like continues from the takeaway, but you know, for you guys advising a lot of the start of the clients that you guys have, what is the top thing you guys see as the most confusing, or what do your clients confuse the most in terms of this situation right now? Because you guys laid the lay of the land out now. We kind of talked through those issues, but what's kind of the big pressing thing that you think everyone has been kind of the most confused on?
Um, I think it's really just this like oversimplistic conception that it's just been fixed and there's a non-issue, right? And frankly not focusing on the fact that there's action that has to be taken to optimize your position. I think that's the biggest one, right? The biggest one. And then maybe the state conformity issues. Um, and I think probably the uh the it's really also the companies that did nothing and didn't comply with the to CJA, like just unawareness that that's like an issue and there's exposure to that. But
Yeah.
how about you,
Um,
from Erica, from the methods perspective?
yeah, so I'm getting a lot of questions on where the catch-up amortization for legacy costs go on the tax return. That's the Form 4562. Um, and then in regards to the issue where clients didn't do anything for TCJA, I actually did have that question come up a few days ago for one of our fiscal year ends taxpayers who is actually not in the OBBA like legal framework yet, just because of the timing of when the tax year begins and ends. They did not do anything for TCJA, and they want to go back and amend their returns to claim R&D credits. So there is a question of can we just amend our return and then treat 174 correctly on the amended returns? The short answer is no, you cannot make a method change on amended return. That's in the code. You need IRS consent to change your method. And the revenue procedure does provide another method change to correct those tax years. It's 265, and you will have a 481A adjustment that is unfavorable. Um, and there is limited audit protection with that because the IRS really wanted taxpayers to comply with the TCJA rules. And so they're really giving the break to those taxpayers that did comply. I would still recommend fixing those years before trying to do anything with OBBBA, so that it's clean. And then if you want to go back and amend and take credits, you can then do that. And then if, you do get selected for audits, the IRS probably will look more favorably on you if you at least try to comply with the rules, even though it's not the first year it was required.
That's some great feedback. Thank you. And another question was if I'm a freelance developer or a solo developer that does hourly contract work, as well as research and developing new products on the side, can I deduct those R&D quote unquote costs for my own time, even though I didn't actually pay myself through that process? Can you maybe talk a little bit, if you can, through that kind of unique scenario? And I think a lot of our members are kind of in that scenario where they might be doing work that is uh, related to other firms, maybe using a R&D election or a R&D deduction. So maybe some clarity around that, if that helps.
Yeah, I could already speak to that. I think I understand the question and the framing. It's actually it highlights some really important concepts. So, my question: so solo practitioner doing development work on an hourly basis, contract work, and also doing building your own products, right, inside, but you're not paying yourself, right? Um, One is there, yeah, it's as the generally as the rules work, right? If you're solo and you're not paying yourself, or I'm sorry, if you're solo and you're doing this development work, some of it's under contract and some internal development. One, there's a question of which of those things can qualify, and it's likely that the contract work you're doing on the side may or may not qualify, depending on the risk and rights. But just setting that aside for a moment, the internal development, yeah, if it meets the four-part test and it's, a 4 or 7 part test and there's technical uncertainty experimentation, you're building or improving a product technique formula. It's, kind of the whole gamut. I'm just kind of breezing through that as if it's a known thing, but there's a framework, right? And assuming that all passes the test in terms of the nature of the cost or the nature of the activity, then yeah, you could establish that you spent X percentage of your time and then you apply that to zero, right? Because you generally apply it to your W-2 box one wages, right? And if you're not paying yourself, then there's nothing there, right? There's nothing to apply it. So it would generally be zero. But there could be other qualifying expenses. Maybe you're using contractors, right, to do some of the work too, or maybe you're building software and you have some cloud spend for AWS spend or something for a development environment, that could be allocable. So I think there could be something, but generally the answer is no to that, right? Because of the fact you're not paying yourself. You could have a scenario too where you are a partnership and you have like general guaranteed payments for services and whatnot. But if it's solo, you're likely disregarded and there's no deduction. It's like a long another story, but great question. I think the general answer is no. Once you start paying yourself, that's when you start looking at it generally.
That's a great answer. And lastly, just to maybe close it off, I think the last question was related to just kind of understanding what's left. And I think I prefaced this earlier, maybe the question was related to that, but prefaced it earlier where we talked about IRS guidances are still, or FAQs and things like that are still being finalized. If I'm a small business kind of trying to understand and read through these guidances, what guidances are already out there that I can look at and talk to with my CPA? And what are some guidances that are being finalized slash still evolving that I may have to consider down the pipe? And I think we went through a lot of those, but maybe we can kind of put those in a bow for as the last question.
Sure. So revenue procedure 2025-28 essentially has all of the options in it. Section 3 has your small business taxpayer relief. Section 4 and 5 have the 280C procedures to either revoke or make a late election for 280C, which is required if you do the small business taxpayer election. So if you do that, you should be doing something with 280C. Section 5 will have your procedures for making the Section 6 will have your procedures for making the election to capitalize and amortize. Section 7 has the automatic procedure for TCJA legacy R&D costs if you didn't do anything and you need to still comply, and that's in 7.01. And then 7.02 will have how to comply with OBBBA with the statement in lieu of 3115. There are also, I think, there's also a section about foreign R&D costs in there. I believe it's under Section 8. And then there's some information, more administrative about audit protection and all that good stuff.
Sounds good. Well, again, I'd like to just thank our panelists for their time today. Again, both of their contact informations are above. Again, cannot advise and recommend these two in terms of knowledge and their expertise around this topic. And if you'd like to learn more about the great work we're doing here at SSBA, please visit our website, SSBA Alliance. So ssballiance.org, or feel free to contact any of us on our websites or emails or anything of that sort. Again, please take a look at this. Anyone who's watching on mobile, take a screenshot, whatever it may be, to get their contacts. And again, I'd like to just thank everyone for their time being here today and taking some time out of their busy schedules to with us. So thank you guys again, and hope you guys all have a great day.
Thanks, everyone.